Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Tuesday, November 9th, 2021. And our top stories today: could there be legislative changes to your retirement plan, IRA, and taxes, and balancing personal financial advice with data privacy? Well, joining me now to discuss this and a lot more, David Levine is a principal with Groom Law Group, an employee benefits law firm based in Washington, D.C. David, it's great to see you. Thanks so much for joining us on the program this morning.
Thank you, Jeff. Thanks for having me.
Absolutely. Let's get to the brass tacks here. Some Americans, I know I'm a little confused here. There was a bill that passed last week, but there's another bill that's being worked on. So can you break down what the events are, so we can keep everything straight?
Sure. Well, ever since the coronavirus hit, we seem to have wave after wave of legislation, and it's hard to keep up, Jeff. You're 100% right. So let's start with where we are today. As many of you will recall, there was a lot of work earlier this year to come up with a bipartisan infrastructure package. The word bipartisan is kind of a strange word for a lot of people these days because it seems like everything is just partisan where the Democrats and Republicans are disagreeing. But there was an agreement in the Senate that led to a bipartisan package that had support from some Republicans, majority Democrats, but really Republicans as well. That was, I'll call it a smaller package that basically provided some infrastructure. I'll call it hard infrastructure improvements. There's a lot in there, and that's a simplified explanation, Jeff. But the key is that finally has moved forward out of the House and now is going forward. However, what we don't have resolved at this point is the Build Back Better program. That is the item that's been getting the real news in the media lately. The Build Back Better program has a whole bunch of things that is infrastructure, but it's like social infrastructure. There's tax changes. There's all these other items. And that's the item that has been pulling back and forth between the progressive wing of the party in the House, the moderate branch of the Democratic Party in the House, and the moderates and the Democrats in the Senate. Why? Because the Republican Party is not signing on to the Build Back Better in any form from what we've seen at this point. So what that means is this is going to have to be passed by Democrats, all with Democratic votes, if it is going to pass. In the Senate, that means you need to get all 50 Democrats because there's only 50, and Vice President Harris breaks that tie if you get all 50 and the bill can pass. There's a whole bunch of wonkiness about, do you need 50 votes? Do you need 60? But in simple form, it's been designed to only need 50 because it's sort of a tax reconciliation bill. In English, there's only certain things that you can put inside, and they've designed it to try to be that. The challenge is in the Senate, you have Senators Manchin and Sinema who have very specific things they want in, out. Some of the childcare things for Senator Manchin are not top of his list. Senator Sinema has her concerns about different things, drug prices, other items, and it's constantly evolving. By the time I record this and by the time you listen, it might have changed again.
Yeah.
In the House side of it, in the House side, you've got another challenge. The House of Representatives, you have the moderate Democrats who have said, well, we want like state and local tax deductibility, which got wiped out by the tax bill during the Trump administration or reduced dramatically to $10,000. And that's in the bill right now. But some of the progressives don't like that. But then the progressives want more money for other social programs and the moderates don't like it. And then it goes back to the Senate. So it is a big, to put it in non-technical words, loop-de-loop. So where does this go is the natural question. Well, they advanced the bipartisan infrastructure package through the House on an understanding from the Democrats between the progressives and the moderates in the House that they will have a vote coming up soon to actually move the other package as long as the congressional scoring, the estimation of what it will cost budget-wise for the package, comes back as expected. Now, there's already some tension because a bunch of the progressives, basically, if you know the name, the squad, some of the more sort of visible progressives, there's a bunch of progressives in the House of Representatives, but the ones that you see, the names, they're called the squad. Some of them voted against the bipartisan infrastructure package. So some of the moderates are already saying, well, the deal we struck, you already broke it. It's going to be some ups and downs. We'll see where it lands, but that's the story, Jeff.
All right. So how does this relate David, to taxation, or potentially, because we don't know if it's going to relate. But how does this relate to taxation, capping IRAs potentially, and some of the retirement provisions that we've heard about? Can you kind of tie that together for us?
Sure, absolutely. To put it simply, taxation, it makes little tweaks on taxation, different taxes for ultra high net worth earners as defined as ultra high net worth. But in the retirement space, I think the real place that this gets into is really in the IRAs and 401ks in terms of caps on large accounts. It puts in rules that basically says after 10 and $20 million, different triggers, different amounts come out. But it basically tries to prevent people from having IRAs and 401ks that go above $10 million. And if it goes over 20, you got to take out even more. Let's say you have great investment return. Now, one thing that did come out of this that was a big change item was in earlier versions of BBB, Build Back Better, excuse me, was a thing that your IRA couldn't invest in anything that required you to be an accredited investor, qualified purchaser. In English, a lot of private market investments. That was taken out of the Build Back Better version that we have today. But given this is constantly changing, we will have to see. There's a lot of people who are still concerned about the IRA changes, but it has improved some with the not limiting where you can invest your IRA. That would have been a big change because as of right now, IRAs do have some things you can't buy, but it's very narrow. And usually they're open to most things. And I think that restores it. So that's a simple explanation of where we are, Jeff.
Right. And as you said, I mean, we're recording this on a Monday morning. By tomorrow, when this airs, things could change. So we're going to put a little asterisk by this. Last question, David. And I just find it kind of the ironies of ironies. So we're here talking about caps on high balances. But the IRS raises, they do every year, right? They look at the cost of living. They look at they adjust sometimes the amount that you can defer into a 401k, 403b, or governmental 457 plan. So this year, they raised the limit, the IRS raised the limit to $20,500. Is that correct?
I believe that is correct. Please don't quiz me because I'm still learning, but I know it's $305,000, I believe, taken into account for your 401k next year.
Yeah, and I just think it's kind of interesting. I'm not going to ask you to comment on this. I'm just going to make a comment that I always think it's interesting. So while we're debating the taxation, caps, et cetera, the IRS goes ahead and indexes limits higher, which could be used by people who have higher balances. They have more discretionary income, therefore they can save more. I just find that kind of unique and interesting.
I'll address it really fast.
Okay.
The IRS, the IRS, is required to follow its statutes, and it says you do index these things. So I'm not surprised. That's the short answer.
Good answer. Good answer. I love how you answered that very succinctly. David, I need to take a very quick break. When we come back, we'll talk to David about balancing personalized investment advice with data privacy. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you over 50? Would you like to get up to 33% more income in retirement? Then call now for this free book, Annuity Do's and Don'ts for Baby Boomers. This free book reveals little-known secrets about annuity strategies that will help you make the right choices before buying an annuity. Call right now for your free book, and as a bonus, we'll also throw in a free annuity rate report, both absolutely free for calling Annuity General today.
Call 800-504-8194.
Welcome back. We're talking this morning with David Levine. He's a principal with Groom Law Group, an employee benefits law firm based in Washington, D.C. David, thanks as always for staying with us this morning.
Thanks for having me, Jeff.
And thanks for breaking down and making in clear English kind of what's happening in the Congress right now as it relates to retirement. So let's talk about privacy. You and your colleague, Kevin Walsh, have been at the forefront of this. Groom Law has been at the forefront of this when it comes to balancing privacy. But let's get an update from you, because there's a lot of tools, techniques, tactics to get people personalized investment advice, and it needs certain amounts of data from the employer or directly from the individual. How do you balance the privacy aspect of all this?
Well, that's a great question, Jeff. And I'll thank you for the compliment on breaking down legislation. I hope I don't fail you on this one, because there is no perfect answer on this one. It depends or maybe answers that us lawyers get pilloried for all the time whenever we get asked a question. Because there is clearly a concern in America as the defined benefit plan system has not completely gone away, but especially in the private sector, there are fewer and fewer employees with defined benefit plans, and they are in the minority at this point relative to the entire population. So most people have 401k plans. If you had a defined benefit pension plan, you generally got a payment for life. It was pretty easy. You knew you were going to get money for the rest of your life. You knew you'd get a check every month. That made it easier to plan. And in some ways, planning could have still been useful then, because hopefully you have outside savings, or you have, at a minimum, hopefully Social Security or other things like that. But now in a 401k world where everything is your account, and that's what your retirement is paid out of your account, whatever it is, understanding how to make that money last is more important than ever. There's lots of different discussions out there at this point between lifetime income solutions and plans that replicate defined benefit plans. But one of the other paths that's very high on people's lists is financial wellness. Now, financial wellness has been actually gaining a lot of traction for well over a decade. There are some innovators that really jumped into big plans in the early 2010s, but it's in the past couple of years that you've seen a lot more focus paid to it by a larger segment of the market. So that's why in some ways it may not be brand new, but more people have said it's more important than ever, because this is the only money you've got for retirement. And then this comes down to a basic question. There's been a lot of discussions, I'll call it, in the benefits media lately about who owns the customer and who owns the client. That's a long discussion we won't have today. But I think in terms of wellness, it's balancing understanding what the data is used for and who gets to use it. Is it used for more purposes? Is it not? If you ask our friends on the plaintiff side of the world, and yes, I said friends because they're very smart people, even though I don't always agree. But the simple answer is that they will say data should not be used by anybody for any other service except for pure 401k. ERISA doesn't say that. It's not what the rule is, but I understand that's the plaintiff's assertion. I disagree. But the understanding that I think people are working through, you have to figure out what hat you're wearing. As a plan sponsor, some plan sponsors think as much wellness as possible, great idea. It doesn't matter if there's some data leakage out here for other purposes, because our primary purpose and incidental effect is not a concern. Other folks out there, plan sponsors will say, I don't want this data being used for any other purpose, whether to get a rollover distribution or anything like that. And the Department of Labor has issued guidance on what you need to do for rollovers and everything recently, and made it clear about its view about what is a fiduciary act. But then you've got the other parts of the retirement ecosystem, whether as an advisor trying to help someone and understand their perspective, or a record keeper doing the same. The lines between when people are comfortable and not, if you had my colleague, Mr. Walsh, and me here right now, we probably have different personal views because we have slightly different views. And I think that's the challenge. And that's where the industry is right now. So in terms of the legal requirements, there's no hard and fast legal requirement. But to me, this is about understanding and documenting the why of why you allow data this way, not that way, to the best you can. And it's not a cookie cutter. There's not one item. It's not all about cost. It's not all about the data. It's about a holistic picture. So you shouldn't, so when someone says you took data, that's bad, that's way too sort of binary, A or B. There's a lot of gray between A and B here in this discussion, and we really need to think about it. So that's a lot to go on. In short, Jeff, it's a bit of a messy landscape, but I think everybody agrees. People need education at this point in a lot of cases, and there's a lot of good solutions. It's figuring out the right balance that we're dealing with.
And you mentioned employers, David. I guess last questions for this segment, but you mentioned employers. What we've seen in some of the surveys by some of the industry members within the retirement industry, and even those doing research outside, is that employees want some level of financial wellness. They just went through a pandemic. They might have creeping consumer debt. They might have lack of emergency savings, but they have said overwhelmingly, at least in some of the surveys that I've read, that they want support. And the employer has a vested interest in ensuring that the person is financially secure, because if they're not going to be a good worker, David. They're going to be distracted. So balancing all this, I think the customers want it. And I think you're right. I think it's striking that very fair balance between giving information and, and getting results from it.
Well, and I think you make an interesting comment. It's important for people to be able to save for retirement, regardless of your views on privacy. And I will vigorously negotiate for clients who want very tight restrictions, but I recognize that there's different frameworks and different bases, and you can justify it in a lot of different ways that are completely, in my mind, reasonable. But I do think that one thing that's out there is if people don't have enough money to retire, you get what I call RIP, retire in place. And we have, for very good reason, age discrimination laws. You do not want to force people because they're older to be forced out of a job just because they're old. That's not appropriate. We all know that. At the same time, I think there can be a collaborative way where people are actually helped to retirement. And that's what the retirement system is for in a lot of ways, so they can be secure in their retirement. But it's also good for business and everyone. I get mocked sometimes for the phrase win-win-win, but it can, in a lot of cases, be a win-win-win.
Yeah, well, we're not going to knock you for win-win-win. We want win-win-win. That's a good relationship, a good transaction. David Levine, always great chatting with you. Thanks for joining us this morning. And we look forward to talking with you again very soon.
Thank you, Jeff. Appreciate it.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to? Drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.